It's 11:15. We're going to go ahead and get started. Can everybody hear me okay? Yeah, too loud. Awesome, guys. Well, like I said, good morning. We appreciate you all being here today. This morning we're going to embark on a journey to unlock the secrets of financial statements. So really, throughout the next 25 minutes, what we're going to do is delve into the intricacies of the financial statements, exploring how to decipher and leverage them so that we can drive success in the world of business. Let's go ahead and get started. Before we start, I just want to let everybody know in front of you there is a brochure. The main thing in here is the profit and loss and balance sheet. Please use this as a reference guide. All right. What we're going to be doing today is really talking about the balance sheet and the profit and loss. So as we're going through these, feel free to either write any questions down. You have a little question box in the back, and we'll be taking some questions and answers, Q&A at the very end. Okay, perfect. So with that being said, like I said, good morning, everybody. So who are we? We are Retanico. We are the founders. This is my wife, Marie, and this is Victor Retano. We are the founders of Retanico Accounting. We're an outsourced accounting firm. We come from Tampa, Florida. You might be wondering, why is the Florida company doing here today? I'm going to tell you what I'm doing here today. 100% of you are going to look to retire. Probably 80% of you are going to look at in Florida. We're already there. So why not come in here and help you build that business so we can build it all the way to retirement? Then again, no business owner is trying to work the rest of their life. We have a vision, we have a goal, but we're trying to pass that on to somebody else. I mean, we're not going to be here forever. Awesome. So, with that being said, our main focus, we're a boutique accounting firm. We provide all level of bookkeeping and CFO services, accounting services, but we do specialize in construction and real estate. We do work with business owners from all industries, but as a civil engineer myself, we're going to be able to provide the majority of value to those who are in the trades or construction industry. In addition, I always forget to mention, we are bilingual. Awesome. So, now you know a little bit about us. I'd like to know a little bit about you. So, who here is a business owner? Awesome. And then how many of you got your returns done on March 15th for your corporate returns? Perfect. Yeah, I'm getting there. And then I'm assuming you all did the personal, right? April? Perfect. And then you said you're in an extension? Okay, how many of you are at the extension? Okay, here's my real question. How many of you, extension or not, filed or not, relied on your CPA to make that happen for you? Okay, because you did not understand your position. Better yet, once he got done, how many of you understood exactly what he did? That is the reason why we're here today.
Now, in order to file your tax returns, what you're going to need is a full set of financial statements. And financial statements, they're not an Excel file, they're not a bank statement, and they're really not what you think that you made last year. And like Victor said, that's exactly why we are here today. Now, some of you might really benefit from having a crash course in how to use QuickBooks effectively. But what if you could truly understand what is needed of your CPA so that you're able to fully create the financials or even understand the financials just on your own? So we're going to start off with the balance sheet. Now, we do find that many business owners, they understand profits, but they don't fully understand how your income statement fully correlates to your balance sheet. Just because you have money in your cash accounts and they're positive, that does not mean that you're making a profit in your business. And here's why. Your balance sheet is comprised of your assets, liabilities, retained earnings, and owner's equity. Next slide. Some examples of assets are going to be your cash accounts. This is your checking accounts, savings, money markets. Then you have your investment accounts, inventory, and accounts receivable, which you're only going to see if you are on accrual basis financials. And Victor's going to talk about that in a little bit. And your fixed assets, which is any large vehicle or equipment purchase. Then you have your examples of liabilities. Next slide, please. That's going to be your accounts payable. Again, you're only going to see accounts payable on accrual basis financials, any lines of credit, credit cards, or notes or loans payable. And lastly, you're going to have your equity portion of your balance sheet, which is going to be comprised of your retained earnings. That is your net income or loss from the inception of your business through the last filed tax year. Then you're going to have your current year contributions or distributions. This is money that you put into the company or taken out of the company as a business owner. And then your net income or loss from the current year. Now, it's crucial to emphasize that the sum of your total assets and total liabilities plus equity equals at the end of each month. If it does not equal, that means that there's some sort of misallocated either expense or revenue somewhere, and that means that, hence the name balance sheet, right? It has to balance. Now, while delving into the discussion of the balance sheet, I want to talk to you guys a little bit more of common mistakes that we see that you could easily identify as a business owner if you pull your balance sheet right now. First thing is going to be negative cash account balances. Now, this is really only going to be true if there are checks that haven't cleared yet that maybe you don't necessarily have the money for, or if you truly have a negative cash balance in your bank account, which hopefully you don't. Misallocation of small items to a fixed asset account. So most companies will have a fixed asset policy, and typically you'll identify it as usually around $5,000. Any purchase of $5,000 or above, you would put to a fixed asset account on your balance sheet. Anything else would be an expense in the current year of purchase. Negative amounts in accounts receivable. That simply means that you over-applied payments to a customer to which there is no corresponding invoice. So that means that your revenues are going to be wrong on your profit and loss. Then you have negative accounts payable. Same concept. That means that you over-applied payments to which there is no corresponding bill in the system. So now either your cost of goods sold or your operating expenses on your profit and loss are going to be incorrect.
And really quick on fixed assets, when we allocate the fixed asset, we need to balance the fixed asset with another account. So for example, if we purchase a vehicle, the fixed asset is the vehicle, but you might carry a note payable on that vehicle. So it's important to create a liability that's going to be the note payable. I see a lot of business owners will allocate the vehicle and the fixed asset, and then as we're making the payments, they're diluting the value of that asset with the payment, not understanding that it goes against the note that they actually have.
Which is a liability.
Right. Also, within your first year of business, you can allocate your business build out, you can correct me if I'm wrong, under the fixed asset. But past that, let's say I buy a computer, I don't care if the computer was $2,000. That's just going to go in your P&L under probably office hardware. We want to make sure that we do have a policy, like Marie said, it's normally $5,000. For smaller businesses, it could be $3,000, for example. So if it's under $3,000, it gets expensed that year, or $5,000, and if it's above that, then we will recognize that as a fixed asset, which will then be depreciated based on a depreciation schedule, not on what we want for a seal ticket. Right? Perfect.
Then we would see with negative credit card balances. That just means that you're applying payments to the credit card, but there are no corresponding expenses. So again, your profit and loss is wrong, and you have to allocate the expenses somewhere. And then lastly is going to be your distributions. Now, a nice thing about having a business is that you can take distributions from your business, right? Typically tax-free. But you need to be careful, because if you do not have equity in your business, negative, that could lead to potential tax liabilities at the end of the year if you've overdrawn on your equity account.
So, to summarize, when you look at the balance sheet and you can look at the example, every single account should be positive. Asset accounts, like cash, are clearly those would be positive. But when we come into the liabilities, while those are in reality negative amounts because we owe them, they are flipped in your balance sheet and they should show us positive. So when you're looking at your balance sheet, anything in here that is negative other than the accumulated depreciation and the contribution and distribution, everything else should be positive. If it's not, it's wrong. And we have to go into it and see what, something must have just gotten booked incorrectly. Sir.
So that's the full scope of the balance sheet. So now we're going to get into the profit and loss.
Alrighty. So profit and loss. The profit and loss statement is often referred to as the income statement, and this is the financial document that provides a comprehensive overview of a company's revenues, costs, and expenses over a specific period. The income statement is a key component of a company's financial reporting, and it is instrumental in assessing its financial performance. So, what are the components of the profit and loss? We can start with revenue. Revenue is simply the section that's going to outline all of the income that your business generated. You can organize the revenue as you want, but if you look at this profit and loss, I believe it just says services. We want to make sure that the revenue is easy. When you're carrying several services and you give me a line of 20 different revenue categories, unless you are correspondingly tracking those expenses, it's just going to mean nothing to you, right? Because you're going to be like, I don't know, maybe you're a painter and you want to identify the difference between how much money you make on painting walls, maybe painting ceilings. There's a lot of people that will break down the revenue part, but again, it's great that you understand how much money you made per category, but if we don't have the expense correlated with that, it's just not going to work out. So, in order to do that, again, we have the revenue, we have all the money that we make based on our service, and then we really want to get into the cost of goods sold. The cost of goods sold, like it says here, represents the direct cost directly tied to the production of the cost of services. So, for every single revenue line item that you have, you should have a cost of goods sold line item to understand how much money it took you to generate the revenue. That is what the cost of goods sold is. The amount of expense that I needed to incur in order to make the money. So, this is my favorite part because this is going to answer the biggest question for everybody. How much should I charge for my service? And the key thing that I hear a lot of people say, well, I'm in line with the industry. But, so you're providing a service like everybody else, right? I mean, let's say you just want to make burgers. Oh, well, I'm selling my burgers like McDonald's sells. Oh, so you're just like everybody else, right? That's what being in line with the industry means. But if you're trying to provide a specific key service that you know I'm the best at, or it's specialized, you're not going to be able to charge like the range of the industry because you're specialized. So if you don't understand how much money it directly took you to make that revenue, you're not going to be able to understand how much you really need to charge. So that is really what the cost of goods sold means, and that's what it means that if I want to track how much, if I want to know how much I earn on painting walls, then I need to track how much equipment I bought to paint the walls, how much paint I used to paint the walls, and how much labor I used to paint the walls. And it must be differentiated from the ceiling if I'm trying to understand which activity makes me more money. Once we understand what the cost of goods sold is and the revenue that we're looking to make, the profit and loss is basically going to generate something that we call the gross profit. And then that leads us into what is known as gross profit margin.
Which is important, especially if you're trying to go get funding from a lender. They will look at that as a key metric. And a healthy gross profit margin, it is dependent on your industry, typically a healthy gross profit margin is between 25%, and it could be all the way up to 60%. So that means that you made 60 cents for every dollar that you generated in revenue, right?
So you're like, Vic, I'm running a great gross profit. I'm making money. Alrighty, so let's look at the other expenses that you're going to incur. These are the operating expenses. Once we understand what the direct cost of buying the material, the labor to get the activity done and collect the revenue, we need to understand how much money it takes to operate a business. You know, we need to eat, we need to pump gas, we have meetings, we need an office. And the thing about operating expenses is that everyone forgets about them until it's time to pay rent. But here's the kicker. If you're a construction company and you have a change order, maybe your project is delayed by a month, you more than likely went into your cost of goods sold to pull out the direct labor, maybe the men that are in that field, the entire material that you purchased to get to put in right to build or do whatever that you're doing. And then you did you add yourself? Did you add your staff? Did you add your rent? Every day that I need to stay on that job is a day that I have to keep my doors open. It's not enough just to be like, yeah, I got a crew of 5 and that's paid for. I'm going to meet my payroll. Boom, I bought my material. Boom. If the office shuts down, if I can't pay my assistants, my accountants, everything that goes with managing and operating a business, those are going to shut down. Guess what's going to happen to that crew? They're going to go somewhere else. So the operating expense as a business owner, it should be a number and it should be off the top of your head. You have got to know how much money it costs you per day, and I would say per hour to maintain those doors open. Like I said, I'm a civil engineer. I come from bridge construction, and when my crews get held up, they're $2,500 a day. You're paid by the hour. Or get out of my way so my crews can perform, because you directed me to be on site. And money talks, and I'm wasting money by being here. So we have to be realistic, but if you don't know what your expense is, you will not be able to have that conversation when somebody's like, oh, well, you know, I kind of changed my mind, and we're always going to run around very wishy-washy people. But we need to be at the forefront of that because that's just business. Not every person that we meet is going to want to really close on 100% already. Sometimes you have to convince them. So again, it is important to understand what is our risk. This is your risk. Because your cost is dollar for dollar. Dollar spent, dollar earned. This is not dollar for dollar. This is your risk. If you mismanage your funds, you blow them here. So, with that, now that we understand the operating expenses, we're going to go ahead and generate what is called the operating income. To me, this number is important, especially if I want to understand if I can increase wages, give bonuses out, or little things like that. These operating expenses will really allow, the operating income will really allow you to understand where you're standing. Like it says here, we got the gross profit, which is revenue minus the cost of goods sold. And then we understand how much it costs us to keep the doors open. We subtract that, and that's the money that we have left. Now, unfortunately, we're not done there. Because you're going to have your cost of goods sold, operating expenses, which are normally monthly expenses like your rent and stuff like that. But other expenses and income are expenses and income that are not necessarily going to happen every day or are required in order to maintain the business. So some examples of these, and I apologize. Some examples of these are going to be, for example, the interest income. I'm sorry? Yes, if anybody wants to give me their information at the end, I'd be more than happy to email the slides to all of you. Yes, sir. So we got, for example, interest income. We have credit cards. A lot of people love the points. They're doing credit card rewards. Great. We're going to allocate that here. But then maybe you have a loan. That interest is a write-up. The principal goes against your note payable, like we discussed earlier. Not a write-up, but the interest is the write-off. And that goes under your other expenses at the bottom of your balance sheet. Don't make the mistake of putting them under your operating expenses. Here's the thing. I have a client whose operating expense is $30,000 monthly. And then they put something, charitable contributions, which is another expense, under their operating expenses. So when I look at the profit and loss, it says that it takes them $60,000 to keep the doors open, but in reality it's only $30,000.
Which has, it's now now lenders, they don't want to give them.
Right. Right. So now you're gonna be like, well, bro, I'm not gonna give you $100,000. It's like $60,000 just here, right? And that was like for the year. We're looking at the entire thing. So it is important that the other expenses of income be classified correctly because they'll kill your operation if you put it as part of your operation.
Don't they look at that as well too?
Yeah. Yes. They're gonna look at the whole thing.
They will look at it.
Because once we have everything put together, we're going to come in against the net income, which is the number that's literally going to translate into the balance sheet. And the net income is basically the company's overall profitability. So did you make money? Positive. If we spent more money than we made revenue, then that number is going to be negative. And then that's the number really that gets translated into your balance sheet, which if you guys look at the example that we provided, you'll see that the net income on the bottom is $140,000, right? 144 million. And then when we go back to the balance sheet right here, you will see that the net income is 144.38. That is also a way to check to ensure that the information from your profit and loss is translating properly to for profit and
And
loss.
it should be your year-to-date net income.
Correct. So, with that being said,
So there is a typical format for your profit and loss. We have seen many clients come to us and everything, categories are kind of everywhere, right? And so if you want to look professional when you're sending it over to either your accountant or even a lender, this is the typical format. You're going to have your header and you'll have your revenues, which Victor already discussed everything. Then you'll have your cost of goods sold, which will lead you down to your gross profit. Right underneath that, you will have your operating expenses, then your operating income, your other income and expenses, and then your net income or loss finally. And that's all on the example that
Now,
we provided.
if I was your accountant and you're like, Victor, I need to, our clients, they're just going to reach out to us with whoever is asking for the financial statement, I'm not going to print this. A banker will never get this from me. This is for you and I.
Unless they
Specifically ask for it. But I'm not here to tell your story. I'm just here to say yes or no. What is the number? If we have several services that we're tracking in cost of goods sold, that's not their problem. That's our problem, right? So again, one revenue line item. I don't care if you have 10 categories. Roll them up. You have one revenue line item. The cost of goods sold, I just show labor, materials, equipment, and miscellaneous. But they're rolled up. Under miscellaneous, you can have dumpsters fees, like if QuickBooks, merchant fees, or stuff like that. We would roll that up. Gross profit, one number. Operating expenses, I have a list, but I break it down and I keep it very clean. They don't need to know it. They don't need to know what they're not asking for. Operating income is just going to be one line. That's 2 lines because it's just your interest expense, interest earned, and if you got a charitable contribution, that's it. That's all they get. And then they get a net income. The balance sheet, when it comes to your fixed assets and all that, it's not broken down. It's one number. So please don't make the mistake. A lot of business owners are not getting the funding because they might have these, but then they turn them in and they look horrible. Half the time you can't read them properly. You see that hours are numbered. That's so that it reads easily. Have you ever pulled up financial statements and you're like, oh, I don't even want to look at this. It's worse than a math problem. Where do I even start? So, and many business owners don't look at their own reports just because they're too complicated. It's too complicated. Perfect. So,
Okay, so we talked about common balance sheet mistakes that we see. Now we're going to talk about common profit and loss mistakes that you guys can easily identify as business owners. And the big one is mixing personal and business expenses. This is really a big no-no. You never want to do this. It's confusing for not only yourself, but your accountant and everybody else. So a good way to avoid this is just have a business checking account, have a business credit card, and just keep everything separate. We're getting questions. Misclassifying expenses. So you want to keep things consistent month over month. So if you classify a vendor to a certain expense expense account 1 month, you want to keep it consistent every other month, because if you don't, now you're not going to be able to have a comparable profit and loss, and you won't be able to see where your fluctuations are.
I recommend that so that doesn't happen, run your P&L but by vendor.
If you're using QuickBooks Online and even QuickBooks Desktop, it's something easy that you could do, and we've inherited a lot of financials from other accountants where they're not putting the vendor name into the transaction, so you're not going to be able to run your expenses by vendor report properly because it's not there. So that's another thing that you guys can check as business owners to make sure that your accountant is doing their job. Depreciation and amortization, that is an item that Victor talked about that's below the line, right? A lot of business owners will forget about this expense until tax time.
What's above the line and below the line?
So above the line is going to be anything that's operating expenses. I would call it under profit. So when I say below the line, I'm talking about anything that's in like other income and expense. Anything above the line is going to be anything literally above that.
It's just a term that some people use, and if you ever hear it, that's exactly what that means. Right, sorry.
Wages. So a lot of business owners, we find that they book their wages net of taxes, but on your profit and loss, it has to be gross, and then you break out the tax portion. A good way to check this is if you're using a payroll provider like ADP, Gusto, Paychecks. At the end of the year, they will provide you with a W-3, and that number needs to match what is on your profit and loss, because that is provided to the IRS before you file your financials.
The first question any CPA is going to ask is, let me see the payroll. And it's also important that you just say, if you look at the profit and loss, our payroll category is 7,000, it's at the very end. You'll see that I have a 7005 category called officer's compensation. The CPA is always going to want to see officer compensation, which is payroll that you're getting, and then they're going to want to see office wages, which is basically the staff within the office. So they're going to need those two numbers separated. So if we're just paying $400,000 in payroll, and that includes you, at the end of the day, he's going to need to know exactly what your W-2 states, right?
But at the end of the day, the both numbers are tracked.
Yes.
And then lastly, just not seeking professional advice. Again, a lot of the times we inherit the books of a well-meaning friend or wife of a business owner who really, they step in the beginning, but as time goes on in a business for, 3-year mark, that's when you really should consider seeking professional advice, because a lot of the time these well-meaning friends and family members, they might do a good job at the beginning, but in the back end, we have to come in and we have to fix their mistakes.
Yeah, I mean, I understand that when we're starting a business, expenses are tight. Maybe we've just been saving our own money to make this job. We have a job, and we're just really trying to transition. So I'm going to say that throughout the first and second year, you're going to ride solo. It's going to be probably one of the loneliest times of your life. But as we're getting into that third year, operations should be ramping up, and you're going to start to notice, like, man, I could do more if I had a proper process, not eating my time, because I feel like I'm just crunching things so manually, because today, right, it's just been you. So how could you, right? But once the third year comes in, you've now been doing it for a while, you really understand who you are within the industry, what you really want to represent, how you really want to sell it, you feel a lot more secure, so revenues are going to start to explode. And then the lack of ability to start having those processes, or I call it the weak, right? The people who are supposed to catch you when you're going to be falling, then you're going to struggle. It's going to be a struggle. So.